So, welcome everybody on this nice summer afternoon. Marianne Sen and myself will guide you through the monetary policy report, but in addition to that, we will also say a few words about the box that we have in the report where we argue about the financial imbalances and how one can factor financial imbalances into our thinking. And then we'll have a discussion based on that. But let me start with the monetary policy report. And as is by now, I take it well known, we decided this time to leave the repo rate at 1%, and as far as we can judge, it's going to stay until, and that's a low policy rate, and that policy rate level will support the Swedish economy. And then as demand picks up in various parts of the world and also as well domestically, that means that inflation will gradually move towards 2%. Now, thing we do presently, and this is of course something that affects us given the openness of the Swedish economy, is done against the backdrop of what happens in global financial markets and what's going on there. And this can of course be described in many different ways. Here we chose just to depict this by picking 10-year rates in the UK, US, Germany, and in Sweden. As you can see here, and which is well known, long rates have gone up, and one can argue about that. But essentially, contrary to many other times over the past few years when we've been sitting here and this is basically good news, because this is sending the signal that particularly when it comes to the US economy, it's on the mend, and that means that eventually the present way of doing monetary policy will be fixed over time. Here, this also affects us because our long rates have gone up as well. But bottom line is it's a good story, contrary to what happened many times. When it Let's try it again. When it comes to what's going on abroad, we see a gradual improvement abroad. Looking at the yellow line, you can see what happens in the U.S. and what we think will happen in the U.S. And that basically tells us a story that growth is going to go up towards 3%. On the other hand, we know what's going on in the Eurozone, and in the Eurozone, growth is really this year on the slow side because the Eurozone is shrinking, while on the other hand, they're actually doing a number of things within the Eurozone, dealing with the problems as they come. There's more to do, but all in all, given the issues when it comes to government debt, the issues in the banking sector, and the structural change that will have to take place in the southern parts of Europe, eventually growth will also come back in Europe. And then if we look at what this means for us with a trade-weighted KIX index here, you can see that growth will also pick up gradually over time, measured in this particular way. And given, of course, the openness of the Swedish economy, that matters actually quite a lot to us. And this can easily be seen from this graph, where you can see the global recovery, the GDP measured in KIX terms, and how close it is actually to our own GDP projection, the red dotted line. The difference in the short run being that consumption is developing quite well domestically, and that means that at least for now our growth numbers are a bit higher than when it comes to the blue GDP measure. But they're very closely related, and that means that whatever is going on in the rest of the world is going to affect us, and quite a lot. In addition to that, there's kind of a dual picture when it comes to the Swedish economy, because given the issues and the problems in Europe, Exports have been on the low side, actually on the negative territory, as you can see here. But once growth comes back in Europe, we expect exports actually to start growing again, both because things will improve in Europe, but also because things will improve in the global economy. And the dualism comes from the fact that, on the other hand, domestically consumption has held up. Consumption has held up well. And looking into the future, we expect consumption to continue increasing at around, let's say, on average, roughly 3% over the coming years. And of course, if you have these two forces pulling in the same direction, that means that in growth terms, that will affect us in a very, very positive way over time. But presently, there is this element of dualism that also plays a role when it comes to the fairly low growth numbers that we observe this year. Now, in labor market terms, this also means that the labor market will improve in 2014 and from then on. But then it's also worth mentioning that we have revised this forecast, so unemployment goes up a bit, and that stems from the fact that the labor force is increasing faster than the employment rate. The employment rate is still going up, which is a very, very good thing in itself. But at least in the short run, the net consequence of this, including the revisions that have been done when it comes to what happens to population growth, is a net result, but unemployment goes up just a little. But then once aggregate demand picks up globally and domestically, then unemployment will go back to a lower level. Inflation is rising. Towards the target of 2%, focusing here on CPIF. CPIF is presently at around 1%. And then gradually, when import prices start going up, when demand picks up domestically, it will be easier to pass on price increases to end consumers. And the general demand situation in the economy, as far as we can judge, is likely to be such that prices will start rising, and in due course, towards 2015, we'll get close to or at our inflation target of 2%. And then, of course, as always, when interest rates go up, CPI will start picking up as well, and that means that once the policy rate starts going up, then we end up with the CPI overshooting, but that's nothing new and nothing different, because that's technically how this thing always has worked. Looking at inflation expectations, they are quite well anchored here. If you look at the one year horizon, which is the lowest black dot there on the right-hand side, it's quite in line with present inflation, and that's usually the way it works. The two-year expectations are a little bit higher, and if you look at a five-year time horizon, inflation expectations are quite well anchored around 2%, and it has looked like that actually by now for quite a number of years, which is a very, very good thing in itself. Now, one of the issues which also matters this time around, and which is very, very similar to what we have argued in the past, is that household debt is a risk. Household debt is likely to gradually increase, and that means that risk stays with us, and it needs to be managed. And that's also one factor that we took into account when we reached our interest rate decision yesterday. And that means that translating all of this into monetary policy, our view is that the repo rate will stay at this level for about a year, and then will slowly go up towards some kind of an equilibrium rate in due course, but it will take quite a while before that happens. And also in the very, very short run, a simple version of this story is basically to say that we have pushed the repo rate past to the right. So technically, the design of the path is roughly the same as it was in April. Of course, it can never be identical because a couple of months have passed, but in terms of what it looks like when you just look at it, then it's basically the same thing. But as always, this is a forecast, it's not a promise. And what could happen here in terms of different things happening? Suppose, for the sake of the argument, that things were to evolve much better in the US than according to our projections, then of course price increases will come sooner rather than later, and that would mean that the policy rate would go up sooner, and there's nothing sort of remarkable about that. On the other hand, suppose that something really unexpected were to happen in the Eurozone, that it takes longer and is more difficult to sort out the issues within the EMU, then that's likely to affect also our exports. Aggregate demand would then be lower in that environment than what we expect, and that would mean most likely that interest rate hikes would be pushed further into the future. So that's where we are. That's where we are presently, and Marianne will now guide you to the box that we have in the report this time, describing how one in sort of semi-technical terms can reflect and argue about financial imbalances. Marianne.
Okay. So this is one of three articles in the report, and I'm going to talk through it now. But first, by way of background, if you think back at the traditional approach of monetary policy with an inflation target, it's you set the interest rate so to stabilize inflation around the target, and some kind of measure of resource utilization around a normal level, and the horizon is perhaps typically about 2 or 3 years. Now, one of many important lessons from the financial crisis is that there are financial imbalances that may be building up gradually, and these, if they unwind in an unfavorable way, they can have very severe consequences for unemployment and growth, and also for potentially for inflation, but mostly for the real economy. There's also the recognition that the monetary policy may have affected to the buildup of these imbalances, and is perhaps today contributing to the buildup of these imbalances. And so many people would argue that monetary policy can contribute to the buildup of longer-term risks in the economy. So if you have that view, then a natural consequence is to extend the framework somewhat and incorporate considerations for financial imbalances in the monetary policy decision. And I'm going to talk now about one way of thinking about this, and this is how we're thinking about it right now, currently, at the Riksbank. Two elements there. One is lengthen the policy horizon a bit, and the second part is to think a little bit more hard about how monetary policy can affect the risk of the bad scenarios occurring in the future. So here's a graph to show, just sort of to illustrate how the traditional setup can be seen. And here we have the so-called traditional policy horizon. So we have about a couple of 2 to 3 years. And the situation here is that we're thinking about two interest rate paths. One is higher, one is lower. And these are the unemployment forecasts associated with those two interest rate paths. So with a slightly higher interest rate path, it takes longer for unemployment to fall down to some kind of long-term normal average. And with a lower path, it's a bit quicker. And if unemployment was all that one cared about, then it would be kind of clear that with a lower interest rate path, you'd have a better outcome, and that would probably be preferable. But what policymakers have been thinking about in the past few years is that there may be risks building up, financial imbalances building up, that if they were to unwind in an unfavorable way, can lead to very, very severe outcomes for the economy. And one way of thinking about this, that there is a probability of a very, very bad scenario, materializing, which would result in unemployment rising dramatically. And it's also seen that monetary policy can affect the likelihood of this bad scenario occurring. So if this is something that monetary policy makers are worried about, this is something that they may want to factor into their decision making. And what it boils down to then is a trade-off between more traditional, you could call it, short-run stabilization concerns on the one hand, and on the other, more taking into account longer-term risks. So this is the general idea. But in order to get a bit further, we have to start asking some questions, because we want to start quantifying these things. So we need to ask two questions. What does the bad scenario look like? What are the effects that we are worried about? And the second question is, what can monetary policy do? So the first question, so what is the bad scenario that policymakers may be concerned about? So this red graph, this is GDP in level. And this is the average over 15 historical episodes of large house price corrections combined with high debt levels. So 15 historical episodes during the 80s, 90s, and 2000s.
Globally.
Sorry?
Globally.
Globally. 15 countries, mostly all of them industrialized countries. This is a subset of the countries that the IMF looked at in their study a year and a half ago. So up until time t, growth was about 2% in these countries, in this sample, and after the house prices started falling, growth became negative, and GDP fell about 4%. So about 4% of GDP is, so to speak, lost in a typical crisis. If you want to relate that red line to some concrete examples, you have here the blue line shows what's happened in Denmark, the Netherlands, and the UK more recently in their current problems with coming to grips with the house price correction. And another example that you may want to compare with is here in Sweden in the early 90s, when we had the banking, exchange rate, and housing crisis in this country. But anyway, so the red line is intended to be a realistic assessment of what policymakers are concerned about. So that was the first question. What's the bad scenario that we're worried about? And the second is, what can monetary policy do about it, if anything? And this graph has a lot of information in it. In the top, this is one way of thinking about decision, and we've divided it into two steps. And if you look at the upper right-hand corner, so to speak, it's to relate the level of debt to the likelihood of a crisis happening. So from the yellow to the red box, with a certain level of debt accumulation, rate of growth of debt, there will be a certain likelihood of this crisis occurring. And if you go to the left, the first step in this chain is actually how does monetary policy affect debt accumulation? So this is one way of thinking about this problem. The advantage of dividing it up this way is that we can use results from studies. Some of them are published, some of them are not. so we can get a feel for what are the likely quantities, the magnitude of these effects. So, and current examples include, on the first step, from the effects of interest rate changes on debt accumulation. There are many VAR studies out there that can give us a measure of how interest rate changes affect debt and debt accumulation. When it comes to the likelihood of a crisis occurring and relating that to the debt accumulation running up to the crisis, there are studies published that we are looking into so we can get a feel of these things. So this is the framework we're looking into right now. Let me underscore that this is still work in progress. We are looking into these different tools, and but what we want to get to be able to better quantify these different these chains of thinking, these effects, and to better in order to quantify the trade-off between the short-run stabilization and the concern for longer-term risks. And doing this way is also a framework that is perfectly compatible with inflation targeting, so to speak. This is not introducing a separate goal. It has to do with concern about stability in the variables that the inflation targeting regime is supposed to be concerned about. And but our goal is to provide more clarity on exactly how the interest rate path is affected by these different concerns. Okay.
So in a very, very technical sense, once we've gained some experience from doing this type of work, eventually my hope is that we can start cranking out the numbers. but that will take some time to sort of do that. But given that this is an issue that has been discussed for many years, and most of the conversation have been of the sort of verbal type, and then we have had the modeling somewhere else. This is an attempt to put it all in one. It's a bit too early to say what will come out of it, but we'll get there. We'll get there. But then, all in all, to summarize, as I started out saying, we do think that the present level of the repo rate is there to support what's going on in the Swedish economy, and given that global growth and also domestic growth will pick up over time, that will mean that, given that it takes a while before this happened, and that means that the rate is likely to stay at this level for the coming year, and then inflation will gradually rise towards 2%. And in that sense, this is a well-balanced way of thinking about monetary policy, given that also the debt issue has given some weight in all of this. So, questions, reflections, comments to this?
So, what's the weight for the indebtedness, or put another way, what repo rate would we have today if we didn't have
that? I can't answer that. I can't answer that question, because then I said that eventually we'll crank out the numbers, but weren't there yet. And then you need to be mindful of the fact that we're talking about 6 people who discuss these things back and forth. I'm perfectly aware of that. In a kind of an ideal, perfect. In an ideal world with perfect models that perfectly depict what's going on in the real world, you can put numbers on everything. But given the uncertainty in this, it's enough presently to say that that matters, but it's hard to pin down a number.
But I guess you are testing the model now with Swedish data, historical data.
Or do you use this global data? You said that on average GDP has... Because you're talking about the indebtedness.
Yes, exactly.
Are there several countries within the sample with the flexible exchange rate and the current account surplus?
Several of them have a flexible exchange rate, and on the current account surplus, that's a little less common. So exactly. So we need to work more on these scenarios. This is a scenario we're looking at now. We need to make it more and more realistic, so to speak. But on the other hand, I mean, there's huge uncertainty around these things, and maybe the best we can look is at history and the historical and what history teaches us, because I think we can always think of very good reasons why crises will not arise.
But this is probably quite a blunt tool to address these issues.
Right, but given that not enough is done elsewhere, this is where we are. But at the same time, one should be mindful of the fact that when you talk about other tools, all those other tools are essentially substitutes for increasing the interest rate. And in that sense, what we really talk about is a reasonable combination of things. If you use other tools, you can sort of direct them towards certain sectors in society or within the financial sector. But on the other hand, when you do that, and we actually do have some experience from that in the past, if you, how shall I put it, if you overdo it, then you end up with too much of a discrepancy between the policy rate and administrative measures that you use, and then that over time at least creates very, very strong incentives for all sorts of arbitrage opportunities in that. So, I mean, these things need to be reasonably aligned. But having said that, given that we have lived in an environment without those tools in the past, at least for the past, let's say 20 years, then there for sure will be, let me call it, elements of learning by doing in order to get to the right mix. It's very, very easy to say when we're talking about monetary policy that this is for somebody else to handle. But no one has as of yet answered the question, then what are they supposed to do? And how would you calibrate those measures? So that we have plenty to think about when it comes to this stuff.
You revised up the unemployment rate. And also the potential unemployment rate. Shall we think about that potential level as the short-term equilibrium or long-term equilibrium? Is it short-term neither, or have you revised the long-term view of the equilibrium unemployment rate?
So let me just go back a little bit. So there's a new forecast for population growth in Sweden. And so there's a larger net immigration, and some of them will enter the labor force, and of those who enter the labor force, some of them will become employed. But given the fact that their profile, they will be harder to employ, so to speak, we've revised up somewhat the long run rate of unemployment, a couple of tenths, and that's what you see reflected in these two lines. So the red line doesn't really go back to the same point where the blue line ended up. So that's and those are the concepts that we work with. I mean, the long run level of unemployment.
But, if you revise both. Yeah, okay, thanks.
But your change seems to have affected your wage growth forecast. It has been lowered. Is it due to higher unemployment and more free resources in the labor market, or what is it? Is it the wage agreements, or?
I mean, our view of the unemployment gap or the resource utilization in the labor market is not very much changed. So the revisions to our wage forecasts have more to do with outcomes.
Because in April you said it was more due to that the labor market strengthened so much that it was close to full resource utilization in the labor market. Your 2015 forecast.
I mean, there is a pickup in wage growth, and it's higher than the collective wage bargaining outcome, and that's due to the pickup in the economy and higher pressure in the labor market as well. I don't know if someone,
No.
my
We have
colleagues
the
wants
same,
to
we have
add.
the same thoughts about this as in April, that we see an increase in wages going forward due to an decrease in, or a better labor market situation. And then we have revised down a little bit the forecast for wages, and that is due to outcome and also due to what's happening in the wage bargaining round now. We see rate coming in a bit lower than expected.
Another question in that area is also the productivity forecast has been lowered. Is it due to new entrants in the labor market, or is it something else in your forecast? Because that, to some extent, counteracting the increased unemployment.
For this year, we have revised up the productivity, and that is due to the outcomes. So actually, the revision downwards going forward is more that it takes...
base effect.
Yeah, it's more base effect, and that hours will pick up. It's just take a little time. So it's more
Because you're
divided between... If you take these
cost-
2 years together, it's the same.
So the domestic cost pressure is all in all not so much changed, actually.
It's more or less unchanged, yes.
It must be terribly hard to make to rely on the models in an environment like this when we have zero rate almost in most of the world. And the reactions we saw 2 weeks ago on the Federal Reserve announcing they would lightly step off the accelerator, and it was well, since beginning of May it's about 100 basis points higher long yields. What if they should? What if they would actually withdraw? Well, first, for instance, the bond buying, and then start to scale down the balance sheet. It seems to be a very, very long way to go, and it would be hard to imagine the model to capture this.
Yeah, I mean, but in the real world, models don't do everything. I mean, you just have to live with what's coming, whatever that happens to be. And of course, one of the issues before us and many others is the fact that when it comes to models, part of this stuff is calibrated during the Great Moderation. And then we know what happened after that. And the things ended up being completely different. And now what we're talking about here today is our own assumptions about gradual, if I call it normalization, in the sense that if you look at all the graphs, they're not, all the projections are sort of, they're not jagged. Because we don't know how to do that. And so the future looks smooth and always approaches kind of a perceived future equilibrium state of the world. But of course, one of the difficulties in all of this is to decide what does that equilibrium look like. Does it really mean that that the future equilibrium monetary policy rate is around 4%, just to pick one issue? What does it mean in terms of assumptions about average growth, and a whole host of other things that are difficult to deal with? And then if you add on top of that sometimes the random nature of reactions in the financial sector to this, that, and the other, then it's hard to deal with. But anyway, I mean, we say that the rate path is it's a projection. It's not a promise. And when things happen, we'll just have to redo things and think hard about where things are going. So I think it's important to be mindful of the fact that it's when it comes to monetary policy decisions, it's much more than just modeling. And in the end, we have 6 individuals together with our staff who argue back and forth about these things. So models are part of it. But the other part is to pass judgment on where we're heading and be prepared to reconsider.
Regarding the household debt situation, we have what underlying assumption are you doing for the housing prices? We have seen it. We have a graph on page 34 where we can see both house and flat and dwellings are going up, have gone up relatively rapidly in the last 1-2 years. You assume that the household debt level will gradually increase. So what underlying assumption do you have for house prices and credit growth? in that respect.
So our assumption for house prices is that they will continue to increase.
In the same pace as today, or more rapidly, or?
No, if you look at the
I
debt,
guess,
if you look at the projection in there, I mean, basically you have house prices, you have how much people borrow, and then you have increases in disposable income. And of course, given that disposable income will increase at a, I don't know what this, at a good pace, if I call it that's a counterweight in the other direction.
I mean, the debt forecasts are in chapter 1.
Yeah.
So that's and so what we see ahead is a slowly rising debt to disposable income ratio.
What we see in the history is that house prices and debt accumulation has increased in the same rate. That's not obvious that it has to be that way, but that's what we see. But our forecast for debt is that it will increase a bit more than incomes. That's why the level is rising.
And it's been like that for a long time, and that's.
Yeah, I mean, the one risk, of course, and I think you are aware of that, is that, I mean, you expect the economy to improve, labor market, household consumption, and so on, and that will also mean that consumer sentiment will continue to improve, and that it could affect the housing price even more in the future, in a positive way.
You can say in our forecast we have like a balance that we will start to increase interest rate, and that will
but
put
it
a
will
bit
take a
pressure on
while.
us. So debt levels will increase steadily.
And there's one issue which is in a kind of a technical one, that it matters when you do the modeling and what's in the box as well, is that, and that's what assumptions you make about people's expectations when it comes to the level of interest rates. Because if people are led to believe that the level will stay low for much longer than it actually happens, then people will borrow more, and then given that a good chunk of the mortgages are variable rate mortgages, if their expectations prove to be wrong, then you'll be really hit when the day comes when policy rates and a whole bunch of other rates go up. So people's expectations within this in this field is something that really matters. And eventually, of course, what matters here is what the view is in the household sector on the real rate of interest, because eventually we're likely to live in a world with a positive real rate and not zero or a negative real rate. And we do know from history that if you have long periods with negative real rates, then once you move out of those states of the world, you end up with all sorts of issues that are difficult to deal with. But I mean, this is a concern, and this is why we're struggling with this. This is why we're talking about these issues, because at the same time, just looking at the data and what has happened in other countries, if you have accumulated debt, and then for whatever reason you decide that we've accumulated too much debt, that is going to have to shrink relative to income. If you have a very rapid decrease in debt, and then aggregate demand really gets hit. And we know that from the US and what happened in the household sector in the US. Now they're at a much lower level than they used to be, and then the housing market is picking up again, but it has taken 5, 6, 7 years to get to that point, and that is what one would like to, as much as possible, avoid. Okay, no more questions, reflections. Thank you for coming, and to all of you who are here and listening in wherever you are in the world on this day in early July. Have a good summer, everybody. Thanks.
Okay. Bye.